FaZe Clan announced on Monday that it's becoming a publicly listed company and will start trading on the Nasdaq. Esports companies going public is rare, but not unheard of. But a company like FaZe that started off as just a bunch of dudes who liked Call of Duty trick shots and is now a global, personality-driven lifestyle brand with aspirations beyond just video games, is reaching into truly uncharted territory. But what really stood out to many as far as the financials was FaZe's valuation upon going public. $1 billion. For reference, Forbes valued FaZe at $305 million in December of 2020. So, what gives? We spoke to Mario Stefanidis, Vice President of Research at Roundhill Investments, an ETF sponsor out of New York City, to get some industry insights into the mechanics and viability of FaZe's historic move. When a company goes public, it can do so via an initial public offering, or IPO. But FaZe is doing so via a special purpose acquisition company, or SPAC. What is a SPAC, and how does it differ from an IPO?
So a SPAC is a special purpose acquisition company, which is a way for companies to essentially go public without the traditional IPO process. Part of the SPAC process, and SPACs are also known as blank check companies, meaning that they're seeded with some money from some investors, and then they'll go out to the market and finance the rest of the amount that they need to make the acquisition that they're looking for. So in addition to the 170 million or so cash that was on the SPAC's balance sheet, they also went out to raise private investment in public equity, which is called PIPE. So the combination of that investor money plus the cash that was already in the vehicle, combined with the shares from FaZe itself, which is about 670 million, that's where you get the valuation of just under $1 billion for FaZe.
They've chosen to go public via a SPAC. Why do you think they went the direction they did?
Faster and lower fees. I think that part's obvious enough. You know, with a IPO, the investment bankers have to do a roadshow. They essentially need to gather parties that are willing to buy the shares, whatever price they're offered at when they go public. You know, that takes up a lot of time. And the other part has to do with the way the IPO is marketed. In a traditional IPO, you're under securities law, and you're very limited in the claims you can say about your company, your prospects. SPACs aren't subject to that stringent amount of securities law, and they can make claims that they wouldn't otherwise be able to make if they IPO'd. So for example, if you read the deck that they put together, they say that in 2025, they'll be trading at 1x revenue, which is pretty aggressive. That's probably a statement that they wouldn't have been able to make if they had on the IPO route.
They say, okay, no, actually, we want to value ourselves at 1 billion. I get that there's a certain kind of multiplier, for lack of a better term, but even by those numbers, this feels, shall we say, generous. Am I wrong in that?
I do think it is generous, especially when you look at revenue multiples for other companies, you know, in the 6 to 8x range for a lot of tech companies. But at the same time, I don't think the 14x multiple is particularly egregious. And that multiple is, by the way, enterprise value, revenue to enterprise value, which strips out the cash on FaZe's balance sheet. Because if someone went in to acquire FaZe, they would be able to use that cash to pay down part of the sum. So the enterprise value is closer to 700 rather than $1 billion. And I don't think it's egregious. I think part of it is Forbes misinterpreting FaZe's value proposition. And I also think another part of it is we've had esports events return in a huge way this year, and there has to be some upweighting of the multiple assigned to these companies.
Merging with a SPAC gives FaZe some wiggle room in which to operate as they try to hit their lofty goals. One of those being that by 2025, it wants to be trading at 1x revenue, a very aggressive benchmark. Now, a big area in which FaZe breaks from other similarly labeled orgs models is in their personality-driven content focus. And while that business model can be risky since it relies more on a company's brand being able to pull in those personalities that produce the content, the rewards have a chance to be very lucrative indeed. It feels like this, FaZe has built a model that is personality-driven. Do you view that as something that could be, I don't know, maybe a worry for people who want to buy and sell in FaZe, especially given this, this big evaluation that maybe, while not aggressive, is still, is still optimistic?
So I think the term esports orgs is a little bit of a misnomer now, because a lot of these organizations have become lifestyle brands rather than teams that solely compete for the victory in their given games. Although I do think we'll stick with the phrase esports team for the foreseeable future, these teams aren't making the majority of the revenue from esports or gaming. In fact, by 2025, FaZe projects that only 3% of the 650 million in revenue that they're forecasting will come from esports. The majority of this revenue is going to come from brand deals, licensing deals, sponsorships, as well as the advertisements that are placed on the streams of content creators or the YouTube videos of content creators. So when you kind of consider all that, yeah, they're really contingent on the continued success of social media. I think they said that they have 34 million followers combined across Instagram, YouTube, TikTok, Twitter, and Facebook. And when you look at that totality and you do the math as to how much each user should be valued at, I think right now their monetization for their audience is 42 cents per user. And what they did was they compared it to how traditional sports teams are valued on an audience basis, and that number really should eventually get into the mid-single-digit dollars, I think. And it may take a number of years for that to manifest, but that's really the goal of any sort of content organization. You aggregate all of your followers under one roof, and then you secure these lucrative licensing and brand deals, which only grow over time due to your consolidated viewership.
So what needs to happen for us to look back in 2025 at this moment and say, wow, what a genius move, and not, what in God's green earth were they thinking? In short, acquisitions and licensing and branding deals. Among other things, think TSM FTX's $210 million deal. Yeah,
so they need to secure some high-profile deals. I look at what TSM managed to do with FTX. So FTX, one of the largest cryptocurrency exchanges, signed a $210 million 7-year deal with TSM to be their exclusive cryptocurrency partner. That deal alone, I think, squashes Forbes's list, because Forbes had TSM, I think, around 300 or 400 million. That one deal is half that. And I think if FaZe could secure a high-profile deal like that, and I think they can do numerous of them because their reach versus TSM is so much greater, I think that will lend credibility to the targets that they're setting out. But nevertheless, their targets are very aggressive. Between 2021 and 2025, reaching 650 million in revenue applies a 90% CAGR, which is very high for any business. So they really need to execute well on multiple fronts, and they also need to be selective with what they do with the proceeds they're getting from this SPAC. Explicitly, they've stated that they're looking for inorganic growth, meaning that they'll merge or acquire other companies to kind of grow in that way. I'd be interested to see what types of companies are targets for them. Is it other esports teams? Is it media brands? I think they can go a lot of different ways, but again, given the limited capital that represents, I think they need to be selective in what targets they choose. At the same time, going public really opens them up to the capital markets. It's pretty easy for them now to do a secondary offering on exchange and raise more money via equity. They can always issue debt, although it'll probably come at a pretty high price given their risk profile. But these are all options that are now available to them that weren't necessarily available when they were a more private, obfuscated organization.
Private companies act thusly with their financials, privately. But even though the laws aren't quite as strict around SPACs as they would be around just a more traditional IPO, a publicly traded company has to lay more of its cards on the table no matter its method of going public, even if a lot more chips were pushed in before those cards were shown. Thanks for watching. For more gaming-related content, subscribe to the Esports YouTube channel to stay up to date.